Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to work our way through Twitter, touch a bunch of different topics. Obviously, they're going to be financial topics or commodity related. I'm going to give you my financial opinions, and we're just going to dive right into it. So let's get in there. Let's see what's going on. Again, if you want to follow me, it's at finding_finance. And if you want to become a part of the community, finding-value.com. You can use the word discount in the coupon code if you'd like. So we've got, we already talked about that. So this is what this guy says. He says, we are at complacency. And this is the Wall Street cheat sheet of psychology of a market cycle. Now, this isn't everything. This is certain assets go through this cycle at the same time. Let me say that again. Some assets go through different parts of this cycle at the same time. So the overall stock market, someone says we're at complacency. We just need to cool off for the next rally. That could be the potential case, and I would agree with that. We went through euphoria. We're probably in complacency, given where we are in the cycle of the real estate cycle. But at the same time, we are in the disbelief this rally will fail like all the others in commodities. So we're really low. We're in what I call the bear trap at the bottom of the market in commodities at the same time that stocks are in the complacency way up here. So stocks will come down, commodities will go up, given where we are in the markets. That's my opinion. And we can also see that with evidence on long-term charts for ratio charts and also for commodities priced in dollars charts. Now, this isn't just go straight up. We are going to see volatility. Commodities are generally very volatile, and they're tough to hold on to. It's kind of like having a really hot boyfriend or girlfriend, and they're Jekyll Hyde. Their personality is. They just go from crazy to normal to crazy. That's what it's like holding commodity stocks. You got to get used to the Jekyll Hyde personality traits of the sector. One day they're up 15%, the next day they're down 23%. You're like, what the heck just happened? And it was based off nothing. it's just regular movements up and down. But that's where I think, and remember, this is your lead-in pattern. You get a double bottom, and then you break out, and then that's where we are in commodity stocks. This is your basing pattern here. We've gone through the basing pattern. We've come on up. It says this is a sucker's rally. We've pulled on back. This is your wave one right here, which we've done. Then we get into another wave, and then we get into a wave five. So this is wave three, and then wave five is this little guy up top. Coming down. It's funny because it's true. It says every great trader I know with experience up to 40 years in the markets, they say no idea where this is going, where this thing is going. YouTube influencer who was live streaming video games up until a year ago and is now a macro pundit. SPX is going to 3,600. The one thing I want to say here is we are in an environment where we've got indicators that are basically going against each other. So we have positive indicators that a commodity could go up. We have negative indicators that the financial markets could go down. We've got interest rates looking strong, like they want to continue higher, at the same time that the gold to copper ratio is going lower. I should say copper to gold ratio. And those are in stark contrast to what we've normally seen in market crashes in the last 40 years. So I think what's going on is that the indicators are changing under a new paradigm. And they're not all in alignment right now for a recession or for a move higher. We've got financial markets that look like they want to bring everything down, and we have physical markets with tight inventories across the board. What's going to win? And I think that leads to no idea where this thing is going in the short term. And that's with every great trader they know with experience up to 40 years. I completely agree. I'm in the same situation. You look at all this information, you're like, crap, they're all split. I don't know which way this is going to go in the short term. It says home buying speed is picking up despite a cooler spring housing market as buyers snap up limited listings. Nearly 48% of homes are selling within 2 weeks, the highest share in 11 months. Here's 2023. This is 48% pending sales under contract within 2 weeks. And this is more information telling us that the market is strong, not weak. A lot of the jobs come from the real estate market, from construction, and that's generally what the cycle is. It's the cycle of the construction cycle, the new housing starts, and the jobs that come about from that cycle. That's what gives the economy strength. What Powell is doing is he's fighting this strength because that's where the inflation is coming from. That is the cycle. Graham says there are only two kinds of investors: those who don't know where the market is headed, and those who don't know that they don't know. William Bernstein. I thought that was a good quote. I see a lot of people who are very confident in where they think the market is going to go. They're like, oh, just sell out. Just keep all your money in cash. Are you sure? I mean, if you look at the uranium market, it doesn't look that bad, guys. We could very well rip it to the upside. And when you look at last market conditions and where we were in the cycle, we're basically at the same spot that uranium likes to rip it, which is an increasing interest rate environment towards the back end of that rate cycle, the hiking cycle, and right where they pause. That's also where we see blow off tops in oil. And who says that we are completely done forever? I mean, we could wipe out a bunch of bad debt in the system, bad businesses, whatever. We could have a small recession or big recession, whatever it is. We cleanse all that out and we continue to move higher in commodities for another 5 or 6 or 7 or 8 years. I don't think that a lot of these people know the short term or the medium term. They're just taking best guesses and they're putting their opinions out there. And I think a lot of people are too confident in their opinions. And I am more confident that those who don't know where the market is headed and those who don't know that they don't know. Agreed. Here's uranium miners are cheap versus the metal. Precious metals has geared up again, but uranium is still at the lows. Contrarian buy. Physical market is waking up, it seems. Sentiment is in the basement, and ratio charts like this one look very attractive. Go Grady. I completely agree, 100%. This looks very attractive for a move higher for URNM versus the commodity itself. Guys, uranium does not look bad. We could very well get takeoff here at any point. And everyone else, oh, just switch it to cash. I'm not going to cash, guys. I'm just sitting in this stuff. I did that last bull market and I got left out. It was a fake head and shoulders lead-in pattern, and guess what? It never went down. It went up in the opposite direction. That was at 2000, early 2000s, mid 2000s is when a lot of these charts went vertical, and we had these head and shoulder toppish looking patterns. And everyone's like, oh, this is a head and shoulders. This is totally a head and shoulders. And then it didn't go down. It went up. It just freaking flew. And here I was with a stack of cash in my hand, and a lot of these companies are doing 4, 5, 10x in a few years time frame. It's very hard to chase the market. I'll say that. I was a young investor back then. I just started. It says, lots laughs. You get what you see. The situation in the U.S. shale oil industry is much worse than markets realizes. Trump's drill baby drill won't work in a shale industry that is heading into reservoir depletion. Energy price inflation is still coming. So this is end of the world coming. The DXY breakout confirmed. That's what he's got to the upside. for the DXY. That's a pretty short time frame. This is 2022 back here in 2023, but DXY does look like it's going to strengthen in the short term. Totally agree. This is gold miners follow this, not gold. So this is a pretty good summation of what's going on here. So what this is gold at the top, gold divided by CPI in the middle, and gold stocks. And gold stocks trade very closely to the ratio of gold divided by the consumer price index. So basically what he's saying is, when gold outpaces the inflation, the CPI, gold stocks do the same thing. That makes sense. It just means that gold is going up at a faster pace than inflation, and gold is going up at a faster pace than the input costs of the gold stocks. We are right underneath a long-term trend line where we could break to the upside and go much, much higher, dragging gold stocks out of a major breakout. If that occurs, I think that gold stocks or silver stocks, mining stocks, could outperform for a period of time. The question is, what is going to cause gold to increase at a faster pace than the consumer price index? Maybe we've got fear in the market of a banking crisis, which we do. And that could be a catalyst for something like this to kick off. And then I think what will happen is gold will outperform for a period of time. Gold stocks will do very well. And then oil and all the rest will catch up right behind it. So that's my guess. All right, here's one that I want to talk about. It says, if you own a home, you should have a minimum of $20K in a liquid account for repairs, maintenance, and unexpected events. Do you agree? No, I don't agree with that. $20K? You don't need $20K. All right, let's just like off the top of my head. You're going to have some landscaping that needs to get done. You're going to know that ahead of time. It's not an immediate cost. That's thrown out. So anything landscaping. If something with your sewer on your property goes wrong, yeah, that could be expensive. Maybe 10 to 20K at most. If your heater goes out, you're looking at probably $6,000 installed for a new heater. Windows, if windows go bad, yes, it's a big expense if you're going to change all the windows on your house. Maybe that's 20 or 30 grand. But you don't need to do that immediately, and you could replace a few windows at a time. So I don't know if you need $20,000 in liquid account for repairs, maintenance, and unexpected events. I own a house. I do all of the maintenance on the house. I've done landscaping. I change, toilet handles. I clean out the flushers in the toilets. I basically do everything. I even changed a timer on the washing machine. I changed garbage disposals. I do all that stuff. I haven't spent anywhere near $20,000 in total on this house since I've lived in it since the mid-2010s. So I think that is way too much money. I would say maintenance per month, maybe $100, $200 at most, is probably what I'm paying. And I do have some windows that kind of suck, so maybe I'll replace those at some point. I'm not going to do that. I'll have someone else do it. But I think $20,000 is way too much for that. And I think it highly depends on how much money you make, too. If you don't make a lot of money, then you have to save up more to absorb problems. If you make a lot of money and you've got dividend income, you got all that stuff, you don't really need to have a big account because you can make it, save it each month that you're going. You can also put it on a credit card and just pay the credit card off, which can give you another month of buffer as well. But it depends on how much money you make. If you make very little money and you're pushing your budget, yeah, you're going to have to save more money to absorb certain things. If you're making a lot of money, you don't need to save as much, and you can just, ride through it. If you've got, 100 grand in dividends and you're still working and all that stuff, you're going to be making a lot of money per month. Most online who dunk on 9-to-5s are those less than 30, who never developed a high earning skill set. So obviously their $50,000 a year dead-end job didn't provide them financial or time freedom. Trust me, there are many high-paying 9-to-5 now remote that are 10 times better than building a business. And I think that depends on what you consider to be a high-paying job. I think that when you look at the jobs that are out there, a lot of these companies, I think it highly depends on what company you're in, the products that they sell, what you're trying to manage if you're a manager, and all that stuff. It all matters. If you're at a company that's pretty easy to manufacture something, it's a simple, very simple to build, simple design, and it's not really a ton of different designs, then yeah, it could be pretty easy from a manufacturing standpoint. If you're in sales I don't think is too bad, but you're probably not going to do a 9 to 5. You're probably going to be working a little bit more. And if you're selling a good product, the product may sell itself. You don't really need to do much as a salesman selling a Honda or a Toyota. So, yeah, I mean, it's possible to have a 9 to 5, but there's a lot of really crappy 9 to 5 jobs, guys, that pay a lot. There's jobs that pay $175,000 that are just crap. Like, you do not want that job. I don't care if it's paying 175. You can't have me work 70, 80 hours of work or of a week to do that. It's not a 9 to 5 at that position. There's jobs where they fly you all over the place, and they just treat you like garbage. They're like, here, go over here. You're just the person that does all the crap. Like, you handle implementing stuff at facilities or whatever it is. And I don't enjoy that. There's a lot of things in my job that I would say I do not enjoy. And I think that is it happens to a lot of people that are over 30 years old. They kind of look at their job and they're like, why am I doing this? And it's just, I enjoy some things. There's a lot of things I do not enjoy. And as you get older, I think you just get tired of it. And even though that you might get paid a good chunk of money, you just get tired. And I'm not saying building a business is better or worse. It is different, but yeah, that's my opinion around this. It says, is the copper market in a structural deficit? We believe copper inventory is extremely low and that copper could see a massive surge in 2023, similar to the period between 2005 and 2006. So that's coming from Goring and Rosenzweig. They think that the copper inventories are extremely low and that copper could have a massive surge. That's the financial markets basically going against the physical markets. He's saying the physical markets are incredibly tight. You could say that with oil. You could say that with a bunch of different base metals even. Who's going to win? I don't know. I don't know who's going to win. I don't know if the physical market or the financial market's going to win in the short term. It says, remember, we had years of buildup and credit stress. Yeah, so I already talked about that before. So that's what I've got for today, guys. It's basically the physical markets versus the financial markets and who's going to win. And I would say, I don't know. I don't know in the short term. We'll have to wait and see. Obviously, we could very well see a washout selling pressure move when the markets get all feared up. But that's also an opportunity. If the financial markets go down at the same time the physical markets continue to tighten, that is your opportunity. But that's what I've got for today. Thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. And we'll catch you guys later. This is Finding Value.